There are lots of headlines at the moment about bonds selling off. So in this video, I'll look at the drivers behind that sell-off, but also consider where yields might be headed, also the opportunities that are being created, and the implications for stocks. Now, I'll also, at the end of the video, unusually make a forecast. If you do enjoy our content, please do subscribe to our channel and like this video. So let's look at the great bond sell-off in a bit more detail. Now, if you're not familiar with bonds, remember in this video that when prices of bonds go down, yields go up, and vice versa. They move in opposite directions. And with that in mind, let's look at the sell-off. Here you can see the US 3-month Treasury yield. This is what you'd get if you lent money to the US government for a 3-month period. Also, we'll look at the far end of the curve when you're lending money to the US government for a 20-year period. That's the 20-year yield. Now, the key thing to understand is that different things drive different ends of the yield curve. The short end, the 3-month rate, will primarily reflect expectations about the policy rate from the Federal Reserve, and that in turn is driven by inflation. And while that seems to be topping out right now, that's the blue line that you can see, the other line, which is the 20-year yield, seems to still be rocketing upwards. So that's the sell-off that people are talking about. Higher yields, remember, means falling prices. Now, the long end of the curve is driven by different factors. It's driven by growth and inflation expectations. So later on, we'll see what that means for where yields are right now, also for where they might be headed. But if we do zoom out for a longer time period, going all the way back to 1960, you can see that the recent increase in yields across the entire yield curve has been fairly muted compared to history. Although not many people will remember it, yields in the US were well above 15% for some period of time. But I think what's most shocking about the US yield curve is how rapidly it's moved upwards. In fact, in 2020, in March, the 20-year yield at the long end of the curve, remember, that reached its lowest point ever. And if we look at the shape of the yield curve on that date in March 2020, you can see the whole yield curve was low and slightly upward sloping. But if we fast forward to the beginning of this year, what happened to the yield curve is it moved up. All of the yields moved up, in fact, and the curve inverted. That's usually taken as a sign of recession in the US. But even since the beginning of 2023, between January and October, the long end of the curve has moved up a lot more. So it's moved up by 1.4 percentage points, more than the short end has moved up, presumably because the Fed is now seen as ending its rate hiking cycle or being close to the end of the cycle. What does this mean for bond prices and losses? Well, it really depends on the duration of the bonds that you look at. Longer duration bonds mean that for the same increase in yield, the price moves down by a bigger percentage. It's just a simple multiplier. So for 20-year bonds, the duration will be something like 16 years. So since those yield lows, you can see that the increase in yields has massively negatively impacted the price of long duration bond funds like TLT. This buys US Treasuries which mature in 20 years or more, so it's very long duration, and it's been completely hammered by the increase in yields. That's down currently by over 40%, and it still seems to be falling. And we can contrast that with SHY, which instead of buying really long duration government bonds, buys 1 to 3 year US Treasuries. Very short duration, very rate insensitive. As the yield curve moves up and down, the price moves around a lot less because that multiplier is smaller. And in fact, most of the yield at the moment, because of the inverted yield curve, most of the return is at the short end of the curve, where there's actually less risk anyway. So really the size of the losses you've got on paper for these bonds depends on the duration you chose. And if you go for really long duration, then those are where the biggest losses are. Now, Robin Wigglesworth, who's about to publish a book about bonds, which I'm very much looking forward to, has written this in the FT recently. And he's tongue-in-cheek comparing the losses in the longest dated gilt, which is currently outstanding, which matures in 2073. So this is a 50-year bond. He's comparing the losses on that with things like ARK-K, Cathie Wood's innovation fund. But he also compares it to cryptocurrency and a meme stock called THG. But it is quite shocking that this bond is now down about 80%. But it's not the only long duration bond out there. Many governments chose to issue these very long dated bonds when yields were lower, completely sensibly of course, because they could lock in that low funding rate. And here he's comparing the losses in these 100-year bonds from Austria but also Argentina with the losses on that UK 2073 gilt. So are bonds a complete train wreck and should investors keep away? Well, I'm with Victoria Beckham here, and I think that for bonds, drawdowns don't really matter, particularly if you buy single bonds. So perhaps there are some opportunities in the bond space. Until quite recently, the very short end of the UK gilt curve had very generous yields. These were well above 5%. So I put out this tweet saying, well, I would buy them. And in fact, I did. Now, I locked in that rate for the life of the bond while I owned it. And because I was holding to maturity, I really didn't care what happened to the yield curve. I knew the rate I was locking in on the day I bought the bond. Now, for members of PensionCraft, we have this tracker which is updated daily. And this shows you the yield for individual bonds for the UK. So like a standard yield curve, it goes from 0 years up to 50 years in the future. Here's that 2073 bond, which Robin Wigglesworth was joking about. But notice how now at the short end of the curve, the yields are much lower. They're no longer well above 5%, but they are still quite generous. Where we have seen a big increase in UK yields has been over at the longer end of the curve, between 20 and 30-year maturities. But I said I was going to make a forecast, and I'm going to make it for this bond. It's called T26, that's the ticker. Now notice that the yield for that is currently around 4.4%, and we can split that up into two components. A component from capital gain, you buy at a low price and it matures at a higher price, but also an income yield of about 0.14%, because the coupon on this bond is about 1/8%. So here's the forecast. This is the price of T26 since it was issued, and you can see the overall picture is it started life at £100, it fell very sharply due to the mini budget in the UK, and since then it's recovered quite a bit, although you can see that the price has been fairly choppy. But as I make this video, it's trading for about £91. Now my forecast is that this will be worth precisely £100 on the maturity date. And that'll be on January the 30th, 2026. Now I can guarantee that that forecast will be precisely correct because all bonds mature at 100 and this is a government bond, so it's not going to default. So just as Victoria Beckham said, these drawdowns don't really matter. If I buy this bond now, I can lock in £9 of capital gain completely tax-free if it's outside an ISA or a SIPP, say. That's because you don't pay capital gain on UK gilts. But even if I do hold it in an ISA or a SIPP, which is tax sheltered, then the yield is still not too bad. So I think it's unfair to say that this bond route is all bad, as you might believe if you listen to media stories about it. This creates opportunities. Every time there's a bond sell-off, for whatever reason, could be a mini budget, could be an election, and a party which is going to issue lots of bonds could get into power. I'm thinking of the UK here. Whatever the reason, you can be opportunistic and lock in those higher yields. So a bond route should be thought of as a bond buying opportunity. So we've seen that bonds have sold off. Let's consider the drivers behind that. And we'll go through 4 possible drivers. Driver number 1 is oil. It might seem a bit odd to link the price of oil, which is a commodity, with interest rates, but there is a linkage primarily for the short end of the curve. So if the price of oil increases, that's usually inflationary. A lot of prices are driven higher by the rising price of oil. In turn, that means the central bank is more likely to raise interest rates, or if they're already high, as they are in the US, it'll keep them high for longer. And that's just in case that higher oil price spreads out to other prices. Now remember that the daily production of oil is about 100 million barrels a day. And beside me you can see the OPEC and OPEC plus countries according to their daily production. Now you can see that the countries which produce oil are not countries which are particularly stable politically. And it's also dominated by 2 countries, Saudi Arabia in OPEC and Russia, which is an OPEC plus. I'd also draw your attention to Iran because we're about to talk about that in a few moments. That produces 2.5 million barrels a day. Now, one reason why the price of oil has been increasing recently is that two members of that graph we just saw, this is Saudi Arabia and Russia, have said they're going to cut production this year. And they're aiming for a price per barrel of about $100. Saudi Arabia's cut production by about 1 million barrels a day and Russia by about 300,000 barrels a day. Now that kind of worked. It did push up the price of oil. And the price of oil has been pushed up further by the conflict in Israel between Hamas and the Israeli government. It's often the case that Middle East conflict threatens supply of oil, and that in turn pushes up prices. Now remember that Iran produces about 2.5 million barrels a day, so it is a fairly big contributor to global production. And if the US blames Iran for being behind this attack on Israel, then sanctions could be imposed on Iran such that it can't export its oil. So the already tight supply in oil could get even tighter, and that could push up prices even more. That could be inflationary, and that in turn could drive rates higher for longer. So perhaps that's one of the reasons behind the high yields that we're seeing right now, and part of the reason behind the sell-off in bonds. Reason number 2 is quantitative tightening. Now, the Federal Reserve is seen as a price-insensitive buyer of treasuries, or at least it was until it stopped buying US treasuries and mortgage-backed securities. You can see that the size of its balance sheet peaked, and it's now letting the treasuries mature, and the stock of treasuries and mortgage-backed securities is gradually falling, currently at a rate of about $1 trillion worth a year. So by removing that huge price-insensitive buyer of treasuries from the market, one of the supports for the prices of treasuries has been taken away, and that in turn is likely to have pushed up yields. Reason number 3 is to do with the supply of treasuries. Now, the US government plugs the difference between its income, mostly from taxes, and its expenditure with treasuries. It issues debt. And the more debt it issues, the more supply there is of treasuries, and that tends to push up yields. Now, this data only updates on an annual basis, but you can see that even in 2022, the US was running a fairly large deficit. It was spending about 5% more of its GDP than it was earning in taxes. That meant there was lots of issuance of new treasuries, and as the Fed stepped back from the market, that probably pushed yields higher. So unless the US government cuts back on its expenditure, I'd expect issuance to carry on pushing yields higher. Now, the fourth and final reason we'll look at is higher US nominal GDP. Now, nominal GDP is not what's usually quoted. Usually you see real GDP. Nominal GDP also includes inflation, and when inflation spikes, so does nominal GDP. And you can see that here beside me. Nominal GDP is shown in blue, and the 10-year yield on US Treasuries is shown in yellow. Now, there isn't a perfect relationship between the two, far from it, but you can see that generally where nominal GDP is higher, so is yield on US Treasuries at the long end of the curve. What we're seeing right now is US inflation's falling pretty fast, headline inflation at least, and we're seeing that yields are heading upwards to meet it on the way down. So what we can do if we plot that as a scatter graph is do a very simple regression of one on the other. In other words, for the given level of GDP, which we've just observed, and remember this was published in September, and it's a backward-looking measure for Q2 of 2023, the US yield, which would be consistent with that GDP reading, would be 5.9%. Now, the latest US yield as I make this video is 4.7%. There are big error bars around that forecast, so it could be anything between 5.4 and 6.5%, but you can see that the red blob, which shows us where yields are right now, is below the kind of error bars for the regression. So if we were to be consistent with GDP, then I'd say yields would be a little bit higher than they are now. Now, of course, yields update daily, GDP is very infrequently updated, so probably if we incorporate the latest fall in inflation, this is about right, the yield that we see right now. If we do the same exercise for the UK, that would put UK 10-year yields at around 5.7%, and yet at the moment they're around 4.5%. So there could be a further sell-off to come. But as I say, if you've got single bonds, you really don't care about those yield curve movements. It just means that there could be a better entry point later if bonds do sell off. And finally, let's think about what this means for stocks. If we look at the earnings yield for stocks, and that turns their valuation into something like a yield on a bond, instead of looking at the price relative to earnings, we invert that and look at the forecast earnings relative to the price, and that's a kind of yield. Well, in that case, you can see that the earnings yield for the S&P 500 is lower than the yield on some investment grade US bonds. Now, the credit rating that they've chosen here is BAA. That's just one notch above junk. But think about what this means for US fund managers. If you're targeting returns of around 7 to 8%, which is what stocks usually give, then you can earn that at the moment with these BAA bonds, which are investment grade. And yet, those BAA bonds have a much lower volatility and a lower risk, arguably, than US equities. So US stocks become less attractive as yields rise, and I think this is another reason why the huge rally we've seen in US stocks might start to weaken and start to fizzle out. So the fact that the earnings yield's fallen below the BAA yield is going to be a problem for stocks. But I think there are opportunities in bonds right now, and it's definitely worth monitoring the short end of that curve. If the yields there go way above 5%, well, that's a very attractive buy for a very low risk investment. Now, if you are a member of our community, you can monitor those gilt yields using one of our trackers. We also have lots of members-only content, and you can ask me a question whenever you like, and you can do that via our chat application. So if you want to learn more about that, just go to our website, PensionCraft.com, and as always, thank you for listening.